London, autumn 1976. You step into a high street bank with £500 in savings folded inside your jacket. It took you 8 months to put it aside. Overtime shifts, skipped holidays, careful budgeting. You're not speculating. You're not hedging geopolitics. You just want to exchange some of it into US dollars before prices rise again. Inflation is running above 20%. Your grocery bill is visibly different from last winter. Your mortgage payment has crept higher. The pound has already weakened sharply over the past few years, and the rate written on the board behind the teller is worse than it was a month ago. You hesitate for a second, calculating in your head. If you wait, maybe it stabilizes. If you don't, maybe it falls again. Outside, newspapers mention a $3.9 billion IMF package under negotiation. Gilt yields are pushing into double digits. The Bank of England has been intervening in foreign exchange markets, selling reserves to slow sterling's slide. The language on the front page doesn't say collapse. It says support. It says confidence. It says temporary pressure. But the rate has changed twice this week. You hand over the notes. You are not witnessing hyperinflation. You are not watching a sovereign default. Britain is still Britain. A financial center, a former imperial reserve power, a nation that issues its own currency and services its own debt. There is no missed bond payment. There is no war on British soil. There is no banking holiday. And yet something fundamental is tightening, because what's happening in 1976 is not insolvency. It is compression. A sovereign doesn't have to run out of money to run out of room. It can keep paying every coupon and still lose the flexibility that once made policy sovereign. Britain didn't default. It ran out of optionality. That distinction matters. Over the next few minutes, we're going to break down the 4 structural stages that turned a reserve-issuing nation into an IMF case study. And we'll trace how pressure migrated from the national balance sheet to the kitchen table. Not through panic, not through chaos, through incentives, through arithmetic, through tightening constraints that moved faster than politics could adapt. Reserve currencies don't usually collapse in a single dramatic moment. They narrow, they defend, they adjust, and sometimes they trade autonomy for stability. This has happened before, and it did not require bankruptcy. What happened to Britain in 1976 was not a mystery. It was not a freak political error. It was not a sudden collapse in competence. It followed a sequence, a structural progression that has repeated across currencies, across continents, across ideologies. Different flags, same arithmetic. We're going to break that progression into 4 stages. Stage 1, fiscal drift disguised by nominal expansion. Stage 2, the erosion of currency confidence. Stage 3, the rate defense spiral that begins to turn policy against itself. Stage 4, external constraint, support that comes with conditions. This is not chaos, it is compression. And as we move through these stages, watch how pressure migrates. It begins in government accounts, where deficits feel manageable and growth looks respectable. It moves into bond markets, where yields begin to adjust. It then migrates into currency markets, where traders do not debate ideology, they price risk. And finally, it arrives in households, where exchange rates and interest costs stop being abstractions. Pressure always travels downhill. There is also a clock embedded in this story, though it does not tick loudly. Sterling's stress did not begin in 1976. It had been devalued in 1949, again in 1967. Each episode was framed as temporary. Each was explained as exceptional. Yet, step back and something colder appears. The intervals between currency crises were shrinking, not collapsing. Shrinking. When the distance between stress events narrows, it signals something structural. A reserve currency does not surrender status overnight. It erodes in layers. Credibility thins first at the edges. Then the cost of defending that credibility rises. Eventually, defense itself begins to reshape domestic priorities. Higher rates, tighter budgets, constrained growth. Each cycle leaves less room than the previous one. Optionality doesn't disappear all at once. It recedes quietly until policy choices start to feel forced. By the mid-1970s, inflation above 20% was the visible headline. But the deeper issue was credibility. Markets were beginning to question whether fiscal commitments, wage pressures, and external balances could coexist without sustained currency weakness. Once that question becomes persistent, capital behaves differently. It does not wait for official reassurance. It anticipates constraint. It moves ahead of policy. Confidence moves before legislation. Flexibility disappears before headlines admit it. From that point forward, the menu narrows. Raise rates and slow the economy. Defend the currency and worsen fiscal strain. Accept depreciation and import more inflation. The tools still exist, but their cost rises, and their effectiveness falls. What changes in Stage 2 and Stage 3 is not the availability of policy instruments. It is the shrinking space in which they can operate. That is the clock in 1976, not a countdown to bankruptcy, a contraction of sovereignty measured in basis points, and it begins earlier than most people think. Stage 1, the quiet fiscal drift, is where the danger is seated. Stage 1 does not feel like a crisis. It rarely does. In the early 1970s, Britain was not behaving like a country on the verge of IMF supervision. It was expanding social commitments, managing industrial wage pressures, responding to oil shocks, and attempting to preserve employment in a turbulent global environment. Nominal growth figures still moved. Tax receipts rose in cash terms. On paper, the system appeared active, even resilient. But nominal expansion can conceal structural strain. When inflation accelerates, revenues rise automatically in currency terms. So do expenditures. The surface looks dynamic. The underlying balance does not necessarily improve. This is the first quiet distortion. Borrowing in your own currency creates a sense of insulation. The government issues debt denominated in sterling. It can service that debt in sterling. There is no immediate foreign currency mismatch threatening technical insolvency. That fact alone can generate complacency. If you cannot run out of your own currency, the urgency of adjustment feels lower. But markets do not price only solvency. They price credibility. As deficits widen relative to output and inflation remains elevated, bond investors begin to demand compensation, not because the government cannot print pounds, but because printing pounds changes the value of those pounds. The distinction matters. A sovereign can meet every payment and still erode purchasing power, and erosion, at first, feels manageable. Strip away the macro language and the drift becomes visible at ground level. If your income is denominated in sterling and inflation is running above 20%, your wage adjustments lag. Your savings lose real value. If you hold government bonds, the coupon arrives on time, but the real return compresses. Domestic businesses face rising input costs. Imported goods become more expensive. Exporters gain some competitive relief from currency weakness, but that relief depends on global demand and input pricing. No one event triggers alarm. Instead, the system leans. Fiscal drift in Stage 1 is dangerous precisely because it does not look dangerous. Nominal growth offers political cover. Borrowing capacity appears intact. Employment remains a priority. The trade-offs feel manageable. Yet each year of elevated inflation and widening fiscal strain reduces credibility at the margin. And credibility is cumulative. Once investors begin to suspect that fiscal discipline is reactive rather than preemptive, yields adjust. Not violently, incrementally. The government still finances itself. Auctions still clear. But the cost of funding begins to edge higher, and with it, the sensitivity of the budget to interest rates. This is where pressure starts to migrate, from abstract deficits to bond yields, from bond yields to currency expectations. Stage 1 does not explode. It conditions. It builds the imbalance that later stages must defend. And by the time policymakers recognize that drift has become structural, the room for painless adjustment has already narrowed. The danger is not visible in the headline, it is embedded in the trajectory. Stage 2, the erosion of currency confidence. Stage 2 begins quietly, and then it begins to move faster than policy. By the mid-1970s, inflation was no longer a temporary surge. It was persistent, above 20% at its peak. Wage negotiations were shaped by expectations of rising prices. Businesses adjusted contracts defensively. Households accelerated purchases, not because they were reckless, but because waiting felt expensive. But inflation alone does not trigger a currency squeeze. The turning point comes when markets begin to doubt whether domestic policy and external balance can coexist without sustained depreciation. That doubt is subtle at first. It appears in foreign exchange desks before it appears in speeches. Sterling weakens. Not catastrophically, gradually, then persistently. Each intervention by the Bank of England slows the fall, but it does not reverse the underlying direction. Reserves are finite. Capital is not. Confidence does not collapse. It leaks. And once capital begins to leak, behavior changes. International investors demand higher yields to compensate for currency risk. Domestic savers consider shifting assets abroad. Corporations with foreign earnings hesitate to convert them back into sterling. What begins as marginal adjustment becomes collective movement. Markets do not wait for confirmation. They anticipate constraint. This is the moment when pressure accelerates. Bond yields edge higher, not because Britain cannot pay, but because the real return becomes uncertain. The currency weakens further, reinforcing expectations. That weakness makes imports more expensive, which sustains inflation. Sustained inflation reinforces currency weakness. The loop tightens. Zoom in from the balance sheet and it no longer feels abstract. If your mortgage is variable, rate expectations matter. If your business relies on imported inputs, exchange rates matter. If your savings sit in sterling deposits, purchasing power matters. Even if you never trade currencies, currency movements trade through you. Pressure migrates from markets to monthly payments. And what makes Stage 2 emotionally charged, though rarely dramatic, is the dawning realization that policy tools are reactive. Every intervention acknowledges fragility. Every rate discussion signals defense. Investors begin to test the boundaries of that defense, not maliciously, but rationally. If defending sterling requires higher interest rates, how high can rates go before growth falters? If growth falters, what happens to tax revenue? If tax revenue weakens, how sustainable is fiscal policy? Questions multiply. Flexibility contracts. This is where a reserve nation begins to feel exposed. Britain was not an emerging market experiment. It was a financial center with deep capital markets and institutional history. And yet the same arithmetic applied. When inflation persists and external confidence thins, currency stability demands a price. That price is interest rates, and higher rates do not merely defend a currency, they reshape an economy. Stage 2 is not panic, it is acceleration. By the time policymakers confront Stage 3, the rate defense spiral, the system is already sensitive. Yields are higher, growth is softer. Markets are alert. The margin for error has narrowed, and once rates become the primary tool of defense, policy can begin to turn against itself. Stage 3. The rate defense spiral. Stage 3 is where the tension stops being theoretical. Up to this point, policymakers still have options. They can intervene. They can reassure. They can frame inflation as cyclical. But once the currency begins to slip persistently, one instrument rises above the rest. Interest rates. Raise them high enough, and you defend sterling. Raise them too high, and you wound the economy. There is no neutral setting. By 1976, gilt yields had pushed into double digits. That is not an abstract number. It is a transmission mechanism. Higher yields increase the government's cost of refinancing. Britain did not need to default to feel strain. It needed to roll debt continuously at rising rates. Each auction cleared, but at a higher price. Each increase in yields translated into a heavier interest burden on future budgets. Defense becomes drag. The logic appears straightforward. Defend the currency by tightening monetary conditions. But tightening does not occur in isolation. It filters through mortgage markets. It affects business loans. It slows investment. Growth softens. As growth softens, tax revenues weaken, and when revenues weaken, fiscal deficits become harder to stabilize, precisely when bond markets are watching more closely. Policy begins to move in circles, raise rates to defend the currency. Higher rates slow growth. Slower growth strains fiscal math. Strained fiscal math unsettles markets. Markets demand higher yields. The spiral is not explosive. It is tightening. Zoom down to street level, and the emotional temperature rises. A homeowner with a variable rate mortgage feels the shift immediately. Monthly payments edge higher. A domestic manufacturer postpones expansion because financing costs no longer justify the risk. A pension fund holding long-dated gilts sees yields climb, altering asset valuations and duration exposure. Each actor responds rationally, yet collectively the responses reinforce caution. Liquidity becomes selective. And here is the unsettling truth. The government is still paying every obligation. No coupons are missed. No formal default is declared. Yet the freedom to choose policy narrows with each rate increase. When interest consumes a larger share of public expenditure, flexibility does not disappear in a headline. It thins in budget drafts. Sovereignty does not collapse. It compresses under refinancing pressure. The Bank of England can defend sterling, but only by tightening domestic conditions. And the tighter domestic conditions become, the more fragile fiscal projections look. Markets sense the contradiction, not because they are hostile, but because incentives demand it. If defending credibility weakens growth, and weakened growth undermines fiscal balance, then defense contains its own risk. This is where emotional tension peaks without theatrics. A nation that issues its own currency begins to experience constraint from its own tools. The instrument meant to restore stability begins to generate new strain. Defense becomes self-referential. By the time Britain approached the IMF in 1976, the issue was not immediate insolvency. It was credibility under pressure from rising rates and tightening growth. The external backstop was not sought because payments had stopped. It was sought because policy space had narrowed to an uncomfortable degree. And once external support enters the equation, the nature of sovereignty changes. Stage 4. External constraint. By the time Britain approached the IMF in 1976, the country had not collapsed. It had not defaulted. The pound still traded. Bonds still cleared. Salaries were still paid. From the outside, the system functioned. But internally, flexibility had thinned. The IMF package, roughly $3.9 billion, was not a rescue in the cinematic sense. It was a conditional extension of credibility. In exchange for funding support, Britain committed to fiscal tightening, expenditure restraint, and structural adjustment. The terms were not theatrical. They were arithmetic, and arithmetic is unforgiving. When external financing becomes necessary, sovereignty shifts from absolute to negotiated. Policy is no longer shaped solely by domestic priorities. It must satisfy external confidence as well. That does not mean control is lost overnight. It means discretion narrows. Autonomy trades for stability. For households, this shift does not arrive as a speech from Washington. It arrives through budget revisions, public spending cuts, wage discipline, and altered expectations. Government programs tighten. Public sector growth slows. Businesses dependent on state contracts recalibrate. Workers negotiating pay increases face new resistance framed as necessity. The language changes. Stability requires sacrifice. Discipline restores confidence. Adjustment is temporary, but what has already occurred is structural. The state can still issue sterling. It can still service its debt, yet it now operates within externally validated parameters. Markets are no longer testing merely inflation or growth projections. They are evaluating compliance. Credibility becomes supervised. This is the emotional spike most viewers do not expect. Britain did not run out of money. It ran out of room. The IMF did not step in because coupons were missed. It stepped in because refinancing risk and currency pressure had compressed policy space to a point where external validation lowered borrowing costs more effectively than further domestic tightening. That distinction matters. Liquidity pressure is not insolvency, but it can override autonomy. At ground level, the shift feels subtle but real. Tax burdens edge higher. Public investment slows. Credit remains available, but at tighter margins. The environment grows cautious. Consumers delay large purchases. Firms postpone expansion. Not because of panic, but because the future feels narrower. Optionality has been exchanged for stability, and once external conditionality becomes part of the system, the narrative changes. The crisis is no longer framed as market volatility. It becomes a question of national discipline, of restoring trust, of rebuilding credibility. These are rational goals, but they emerge from constraint, not abundance. Stage 4 does not explode. It formalizes compression. By 1976, Britain had demonstrated something profound. A sovereign nation can remain solvent, maintain institutional continuity, and still experience a loss of policy latitude powerful enough to require external support. No missed payments, no dramatic collapse, just tightening arithmetic. And that is what makes this episode enduring. The mechanics did not end with Britain, and they repeat wherever flexibility thins faster than headlines acknowledge. Strip away the personalities. Strip away the headlines. Strip away the decade-specific politics. What remains is a structural truth. Sovereignty in modern finance is not defined by the ability to print money. It is defined by funding optionality. A government that issues its own currency cannot be forced into technical default in the same way a corporation can. It can always create the units required to service nominal obligations. But that is not the same as preserving credibility, purchasing power, or stable refinancing costs. The real constraint is not the printing press. It is the market's willingness to fund you at tolerable terms. Funding optionality rests on 3 pillars. First, currency credibility. If investors believe inflation will erode returns, they demand compensation. That compensation shows up in higher yields and weaker exchange rates. Credibility does not collapse overnight. It decays at the margin. Second, domestic absorption capacity. Can domestic institutions, banks, pension funds, households, absorb government debt without destabilizing the broader system? If they can, the sovereign has flexibility. If they cannot, reliance shifts outward. Third, refinancing cost stability. Debt is rarely static. It matures, it rolls, it resets. When the cost of rolling that debt rises faster than growth or revenue, budgets tighten even without new spending. This is where the emotional temperature rises again, not because of spectacle, but because of inevitability. When all 3 pillars weaken simultaneously, optionality contracts. Britain, in 1976, still had institutions. It still had a currency. It still had productive capacity. But currency credibility was strained by persistent inflation. Domestic absorption faced limits as yields climbed. Refinancing costs rose in tandem with interest rates. None of these alone triggered collapse. Together, they reduced freedom. And once freedom narrows, choices become reactive. Optionality does not vanish with a headline. It erodes through basis points. That is the uncomfortable insight. Sovereignty is not binary. It is elastic. It expands when credibility is abundant. It contracts when markets demand reassurance. In 1976, Britain discovered that even a reserve nation can experience contraction long before insolvency. This is why the IMF's presence was not theatrical. It was mathematical. External funding restored part of the lost optionality by lowering perceived refinancing risk. Conditionality was the price of regaining that margin. Stability, in that sense, was purchased. And here is the deeper emotional spike. The public rarely experiences the moment optionality disappears. By the time it becomes visible, it has already been traded for stability. Flexibility is surrendered quietly. Constraint is formalized later. That mechanism does not belong to 1976 alone. It belongs to any system where debt rolls continuously, capital moves freely, and credibility is priced daily. Widen the frame. The flags change. The decades change. The financial architecture becomes more complex. But the variables, the ones that mattered in 1976, remain stubbornly familiar. Debt to GDP trajectories rising over time. Interest costs absorbing a larger share of government revenue. Maturity profiles shortening, forcing more frequent refinancing. Capital moving faster than policy can respond. Different country, same arithmetic. Today, sovereign balance sheets are larger. Markets are deeper. Central banks are more sophisticated. But the core dynamic has not evolved beyond recognition. Governments still roll debt continuously. Investors still price inflation expectations into yields. Currency credibility still determines how much policy flexibility a nation retains. The difference is speed. Capital now moves in milliseconds. Information spreads globally before press conferences conclude. Domestic bond markets are intertwined with international funds. When refinancing cycles shorten, when a larger share of debt must be rolled within a few years rather than decades, sensitivity increases. Small yield adjustments translate into meaningful budget shifts. Pressure accelerates. And here is the emotional spike that makes this relevant beyond history. The loss of optionality does not announce itself. It does not wait for political consensus. It does not care about electoral calendars. It emerges when interest absorbs a rising share of revenue, and when investors begin to question whether future policy adjustments will outpace structural strain. Flexibility fades before narratives change. This is not a prediction. It is a pattern. Britain in 1976 demonstrates that even established financial systems can find themselves negotiating with external confidence rather than shaping it unilaterally. The mechanism was not exotic. It was incremental. Fiscal drift, currency erosion, rate defense, external constraint. If refinancing cycles shorten while interest burdens rise, what happens to discretion? If domestic absorption weakens and capital becomes more mobile, where does pressure migrate first? Those are not rhetorical questions. They are structural ones. The lesson is not that collapse is imminent. It is that sovereignty operates within arithmetic boundaries. When those boundaries tighten, adjustment becomes less voluntary. Optionality contracts before headlines declare crisis. And once contraction begins, reversal requires either restored credibility or external reinforcement. Britain found reinforcement in 1976. The arithmetic forced the decision. The variables look familiar. The mechanisms endure. Step it back. Remove the names. Remove the speeches. Remove the IMF headline. What remains is a four-stage squeeze that does not rely on panic, only on arithmetic. Stage 1. Fiscal drift masked by nominal expansion. Stage 2. Currency confidence begins to erode. Stage 3. Rate defense tightens the system from within. Stage 4. External support formalizes the loss of flexibility. No explosion, just compression. In 1976, Britain did not wake up to a single catastrophic event. It moved through layers. Each layer narrowed the next choice. Deficits looked manageable until yields rose. Yields looked tolerable until growth softened. Growth looked cyclical until refinancing costs absorbed more of the budget. By the time external support became rational, optionality had already thinned. Pressure migrates. It never stays still. From fiscal accounts to bond yields. From bond yields to exchange rates. From exchange rates to households. And here is the uncomfortable clarity. None of these transitions require incompetence. They require incentives. Markets price risk. Governments defend credibility. Households respond to cost changes. Each actor behaves rationally. The system tightens anyway. Arithmetic does not need villains. Britain's experience demonstrates something that feels emotionally sharper than collapse itself. A nation can maintain institutional continuity, avoid default, and still experience a contraction of sovereignty measurable in basis points and conditional agreements. No missed payments, no dramatic implosion, just shrinking room. That is the structural compression. Reserve status delayed pressure. It did not eliminate it. Sterling had history, institutions, deep markets. None of those disappeared in 1976. What changed was the balance between funding cost and policy flexibility. When defending the currency required higher rates, and higher rates strained fiscal math, the system crossed from choice into constraint. Sovereignty is not a slogan. It is a funding condition. A government that can refinance cheaply has options. A government that must refinance under pressure negotiates with markets. If markets demand reassurance, policy narrows. If policy narrows, growth adjusts. If growth adjusts, fiscal projections shift again. The loop is mechanical. Britain did not fail in 1976. It adjusted under constraint. It traded discretionary space for restored credibility. It regained stability, but at the price of externally validated discipline. Collapse is loud. Constraint is quiet. And quiet constraint is often more instructive. Because the lesson is not about Britain. It is about structure. When refinancing cycles shorten, when interest burdens rise relative to revenue, when currency credibility thins, the menu of sovereign choices contracts, even if every bond is paid on time. Optionality defines freedom. Arithmetic defines optionality. Comment funding optionality if you see the pattern. There is a moment in every sovereign squeeze that almost no one recognizes in real time. It is not the IMF announcement. It is not the rate hike. It is not the currency headline. It is the moment when policymakers realize that every option now carries immediate cost, and none restore full flexibility. That realization rarely makes front pages. In 1976, Britain did not implode. It recalibrated, it tightened, it negotiated, it endured. History does not remember it as a collapse, but structurally it was a warning shot. Even established monetary systems operate within boundaries. When those boundaries tighten, adjustment becomes compulsory. What makes this episode emotionally charged is not catastrophe. It is inevitability. Because nothing in this sequence required panic. Each stage was logical, each decision defensible, each adjustment rational. And yet, taken together, they formed a squeeze that narrowed sovereign discretion. No villain, no drama, just constraint accumulating. And that is what makes it unsettling. If you had stood in that London bank in 1976, exchanging £500 into dollars, you would not have felt like you were living through a structural turning point. You would have felt prudent, sensible, cautious, but multiplied across millions of similar decisions. Cautious households, cautious investors, cautious corporations, the system tightens. Confidence shifts incrementally. Yields adjust marginally. Policy responds defensively. Optionality contracts quietly until it must be formally restored. That is the emotional spike history leaves out. Most sovereign squeezes do not feel dramatic. They feel incremental. The danger is not spectacle, it is accumulation, and accumulation is harder to notice. Britain regained stability after 1976. Institutions endured, markets normalized, but the arithmetic did not disappear. It demonstrated a rule that extends beyond any one country. Sovereignty in modern finance is conditional on credibility, and credibility is continuously priced. When refinancing costs rise faster than flexibility, sovereignty narrows, even if insolvency never arrives. That is the pattern. Not collapse. Compression. And compression, once it begins, does not negotiate with optimism.